Well, we have a pretty packed agenda, so I think we should start talking about it. As I mentioned, my name is Valerie Vidala. I'm a volunteer at Work on Climate, which is sponsoring this event. I'm joined by Nicolette Bertke, Barbara Garnell, and Angela McDonald, who are on our events team. They're helping to monitor the chat and support on the tech side. In terms of agenda, Matt's going to be presenting for the first half hour. After that, we'll go into break rooms for case studies. And finally, we'll come back to the main room to discuss findings and observations. Just so you know, the session will be recorded. And when applicable, we'll attach links in the chat. So keep an eye on that. Matthew has a lot of valuable insights to share today, so we want to move on pretty quickly with this. But I would like to tell you a little bit about Work on Climate, because I think there are some people on the call who may not be members yet. So with over 28,000 members and growing, Work on Climate, which is a nonprofit organization, is the world's largest, most active community addressing talent shortages in climate. We're on a mission to transform the talent ecosystem and build the workforce humanity needs to solve climate change equitably and justly. Our goal is to make climate work mainstream, empowering hundreds of millions of people everywhere with the skills and support they need to use their talents to build climate solutions. Going a little deeper, this event is sponsored by the Learn Finance channel on the Work on Climate Slack community. Learn Finance is a sub-community, and it's focused on building climate skills in finance-adjacent roles, things like carbon accounting, ESG reporting, project finance, sustainable investment analysis, and climate risk. The Learn Finance channel provides members with access to climate finance resources, collective problem solving, knowledge sharing, and industry experts. So I encourage you all to join. Okay, at this point, I'm very happy to be introducing our guest, Matthew Sekol. Matt is a sustainability global black belt at Microsoft, serving as an ESG advisor to companies. He's contributed to white papers on ESG topics such as biodiversity and ESG data quality, and he's presented on the intersection of ESG and technology in higher education. He has an upcoming book called ESG Mindset, which is due out in April, and that focuses on corporates. And finally, he publishes a weekly newsletter that I think just went out today called the ESG Advocate, and you can find that at esgadvocate.substack.com. Take it away, Matt.
All right. So, hey, folks, my name is Matt Sekol. It's great to be here. Just give me a second while I set up my PowerPoint. There we go. All right. So we thought we'd kick off today with just a little bit about how I got into this space. So if anybody, if you can't see my screen, let me know. I'm assuming you can. So my name is Matt Sekol. I'm a sustainability global black belt at Microsoft, and I'll cover off on what that means in just a minute. But I'd like to share with you a little bit about my journey to ESG. Now, full disclosure, I am not here in my official Microsoft capacity, so any opinions expressed here are Matt's own opinions and not those of Microsoft, which I kind of feel like I have to say when I'm talking about this topic. Now, I had a pretty traditional 15-year career in technology, mostly IT, supporting various companies. None of them, unfortunately, were financial services, although one was energy trading and taken down with Enron. I had a quick stint as a Microsoft partner for 3 years, leading the services practice, and then I joined Microsoft in a sales role supporting financial services. I quickly moved into a role called Industry Advisor for Capital Markets, where I supported the industry perspective and primarily worked on building 2 separate commercial motions. One of those was focused on private equity, which is still very much in place today. And the other one, I attempted to capture an ESG data play for the markets, but it didn't work out quite the way I thought, and it's a much longer story than I can get into here. Now, during that time, a coworker of mine who was ex-Morgan Stanley brought me into an opportunity to invest in Morgan Stanley's Next Level Fund. This is a fund that invests in Series A and Series B diverse, led, and founded startups. We went to Microsoft Finance, convinced them to invest, and her and I now run the fund for Microsoft as part of the LP Advisory Committee. I like to think of it as a ESG fund because a lot of the diverse founders are trying to solve problems in their communities or, related to their diversity. Now, ultimately, as I focused more and more on ESG, I explored opportunities within Microsoft, and I wasn't finding many things. So at the time, we were developing a commercial product for environmental accounting, and when the first opportunity opened up for me to join that team, I jumped at the chance. Today, I'm still on that team. Mostly, I focus on the big advisory partners to make sure we're driving towards that ESG data opportunity that I was never quite able to get going in capital markets. But ultimately, I consider myself to be a benevolent troublemaker, which is on my LinkedIn headline. I like to stir the pot around this topic because I find that there's a lot of confusion and missed opportunities out there. And this led me to start the Substack that Valerie mentioned in the summer of 2022. This attempts to tackle various ESG topics and trends. Sometimes it's financial services focused, sometimes corporate, sometimes technology. And I found that I was writing so much that I had time to write a book, which is what I ended up doing. The reason why I wrote a book was that all of the ESG books I found when I was exploring this topic were focused really on the financial markets or doing well by doing good, which I know is a big topic for work on climate, but not quite what ESG is. So I tried to write a book, hopefully, that makes ESG accessible from the board to individual contributors to help companies understand that the path to saving the world for them lies in their unique understanding or material impact. So at the end of the session, as Valerie said, we'll pop up a QR code to link to the book if you're interested. So the big question of the day, what is ESG? This has to be the starting point for any discussion about ESG because across markets, companies, and even now politicians, you will hear different definitions. I tend to go back to its original purpose, which the UN Environmental Program Finance Initiative created in the 2004 white paper, Who Cares Wins. And so you can see the definition there at the top. ESG represents material, environmental, social, and governance risks that affect a company and opportunities that drive towards long-term value and sustainable growth. In other words, ESG is not investing, it's not data, although it can be informed by data, but it's a framework for thinking about how ESG issues affect a company, not necessarily the company's impact on the world, although that does get complicated, and we'll talk about that in a few slides. Now, for example, for the environment, this means managing something like transition risk, which is a hot button topic for energy companies today. But it's also managing physical risk, like extreme weather events supercharged by climate change. For example, in 2011, flooding in Thailand shut down the hard drive industry for weeks, and that rippled out to both semiconductor and computer manufacturers, of which I was at one of those at the time. Regarding the social, diversity, equity, and inclusion and social justice certainly have intersections, but it's also about stakeholders and their diverse perspectives. This could range from something like supporting pay equity to make sure that you attract and retain top talent, but it's also about keeping your employees and the communities in which you operate safe. Now, regarding governance, this is critical, but often surprisingly overlooked. Governance has proven to be the one thing that can take a company down. Enron, WorldCom, these are examples from the early 2000s, which led to broad regulations like SOX. But more recent examples can be found in Boeing, Tesla, and even Silicon Valley Bank. And if there's anybody on the call from Silicon Valley Bank, I apologize, but I wrote about it in my Substack last year. Now, there's also a bonus one here for you in the lower right there, which I kind of highlighted. When talking about ESG, I like to add technology in as a fourth pillar because technology is as fundamental to business as any of the other pillars, and it can address the other pillars as well, plus core business issues. I'm convinced that had ESG been coined just a couple years later, like let's say after the release of the iPhone, that technology would have been added as it has the same risks and opportunities and long-term growth potential as the rest of ESG. Now, as I mentioned, ESG was first coined in 2004 by that UN program as a financial concept born out of the idea that the effect of ESG issues on a company may be profound, but it didn't take off right away. In 2004, the business world was still largely focused on Milton Friedman's economic perspective. Friedman wrote his famous doctrine in 1970, largely in response to the activism of the 1960s. His perspective was that a business's role and social value was to increase its profits. Profits, therefore, shouldn't be used by a company for pursuits outside of this purpose. Friedman's idea was largely one of an extractive economy, the one that we live in today, and shareholder primacy. However, in this UN paper published just a few months before Who Cares Wins, there was another paper that came out just a few months before. This insight was published. And I'm going to just read the quote. Analysts agreed that environmental, social, and corporate governance criteria impact both positively and negatively on long-term shareholder value. In some cases, these effects may be profound. It follows that research to determine the financial materiality of these criteria should use longer time spans than is currently the norm for financial analysis. In other words, there's something here, materiality plays a role, and maybe our quarterly reporting isn't that great in supporting this, which, by the way, we still do, at least over here in the US. I know the EU has gotten away from that. This was really the beginning of ESG. Again, some companies latched on to this idea, others just simply trucked along doing whatever they were doing. But then in the 2010s, something changed. Starting in 2015, Larry Fink, CEO of BlackRock, began to write about ESG concepts, moving into the alignment of purpose and profitability, including calling out stakeholders specifically in his 2019 letter. This call out happened the same year that the Business Roundtable, which is made up of US CEOs, also pivoted its principles of corporate governance towards the broader stakeholder view, away from shareholder primacy. That year, the Business Roundtable listed several stakeholder groups, customers, employees, suppliers, communities, and shareholders in its principles of governance. And this was just one of the many tipping points around the late 2010s and 2020s. In addition to that shift of stakeholder capitalism, again, born from that market perspective, there were other tipping points surrounding 2020 specifically that dramatically shifted the corporate and market perspective. Of course, 2020 was a big year for social and stakeholder issues. First, COVID completely changed the nature of modern work and modern life. The US saw the horrific murder of George Floyd, bringing stakeholder attention to systemic racism. And new waves of stakeholder engagement, cancel culture hit companies and firms. Meanwhile, extreme weather events started to gain more attention as the global north wasn't spared. In 2021, Germany experienced catastrophic flooding that almost took down the insurance and reinsurance markets. Greece and North America have seen horrible wildfires in the past few years. In fact, even Warren Buffett, who famously does not like ESG, called out the risks of wildfires to utilities in his latest annual letter. Lastly, governance, which again is critical, is getting mixed results. The people on the board, their skills, and their influence are critical to how companies run. In fact, recent regulations like the SEC climate rule and even cybersecurity regulation cover the board experience of these issues, but again, they're often overlooked. Now, the fascinating thing to me about ESG, in case you haven't picked up on this yet, is that it was born and accelerated out of the financial markets, but applies to corporates. Again, this is kind of why I wrote a book about the topic. This acceleration has come back into the markets and fueled two things, opportunity, but also confusion. So just like corporate attention, there's historically been some attention on ESG matters from the markets, but these did accelerate as well around 2020. Now, starting with banking, banking has been focused on financing the transition for some time. There are interesting new partnerships emerging, like Walmart partners with HSBC to fund their suppliers' transitions. And of course, loans focus on different types of sustainability projects, including ones that incentivize progress like sustainability-linked loans. Of course, in that portfolio are assets that are subject to physical risk in the real world, like mortgage loans and climate risk. Now, moving on to capital markets, we've well covered where ESG started, which is in the capital markets, and they continue to leverage their influence in various ways. As we'll see, some capital markets firms have stopped talking about ESG altogether, and others use various means to support investment products. There's a few other ways, though, besides things like investment funds, that the capital markets leverage for this influence. Things like divestment, which CalPERS, the biggest pension fund in the US, famously did with tobacco in the early 2000s. Divestment loses influence, but is some kind of indirect pressure. More direct pressure is through proxy voting and stewardship, which we'll talk about in the use case. However, in the rush to capture shifting social sentiment around the 2020 timeframe, many firms launched new ESG labeled products that either saved the world, or were trying to, or were actually ESG focused on risks and opportunities. This created a lot of confusion, and I'm not sure that the rise in disclosure regulation has helped. Now, you might think that insurance would be the furthest along with ESG since they deal with core risks and are famous for their large actuarial models. But the world has changed so much since 2020, it's difficult to model things like weather events when every week brings another once-in-a-century extreme weather event. We've seen the results of this with insurers exiting the homeowners market in the US especially. They just can't keep up. Still, it's worth noting, just a quick side note, that this isn't the only intersection of insurance with ESG, as the rise of intangible value plays a role with things like protecting material company issues like intellectual property and cybersecurity. Again, that technology in ESG. Now, each financial services segment intersects directly with this topic uniquely, but there are some universal truths, like data sits at the center of any informed decision, as it does with any company. So just like for the board, you can't make, in financial services, you can't make decisions about the interconnected nature of the modern world with internal data silos. So pulling together ESG data starts with the company level and self-reported data. Companies need to bring together ESG, operational, and financial data all together and report it out to stakeholders. This includes information about their value chain as well. And it goes beyond scope 3 emissions, all of their value chain operations to understand their risks and opportunities. Of course, financial services firms can pick up this data from the company directly, typically through like a CSR or impact report, or through subscriptions with ESG data providers. Speaking of which, there are all kinds of non-traditional data that firms can pick up. Some have subscriptions to the ESG data aggregators, which many of them do. But there's also things like social media trends, or there's great information that can be found from NGOs. Even things like industry digital publications contain information about upcoming innovations that every company should be aware of for their industry. And the firm can use that information to determine who's paying attention to this innovation and who's mired in inertia. And then lastly, there are global geospatial and social data sets that can yield localized information about climate change, where people live and work, and what those risks might be. This is invaluable for uncovering physical risk, and it's also playing a rising role with understanding biodiversity. Now, when I used to talk about this data, which this is probably the closest that I'm going to get to my actual job is this slide, I would typically focus on the quantitative aspects because the world had tools to deal with metrics like through machine learning. Machine learning can easily find patterns in the data and correlations. Now with generative AI, there are new ways to find relationships across companies using the non-traditional information they publish out, like regular news stories and content. This has the potential to shift the landscape of ESG analysis entirely by going past the metrics to the context and storytelling that a company is publishing. By the way, I was an English major, so I'm a huge fan of the context and storytelling. Now, here's some trends that we're going to cover. So since about 2019, I've been talking largely with financial services firms, but also some companies about ESG. From those learnings, there are a wide array of things that I've heard and seen in practice. Many firms are struggling with their data. this manifests in a build versus buy flip-flop, where firms are building solutions from scratch, in some cases trying to reverse engineer what the ESG data aggregators are doing. Then they find out that they don't have traceability from the score back to the data, and then they go back and buy something. I've seen this go back and forth for years, is what I've heard, even though I've only been talking about this since 2019. It's been going on for a while now. The firms can't seem to find the right mix of data providers and a data solution to do what they need. So it just goes back and forth. Now, we're also seeing governance be a big theme, and we're in the middle of proxy season right now. The big asset managers we'll be discussing today have issued proxy voting choices to their investors to give them more say in how their proxies or their stocks are voted on. So firms still, though, haven't figured out how to assess the board experience and their capabilities. And there's a lot of governance issues out there. If you follow the news, you can kind of uncover them. And this is what I write about a lot in my Substack. Only 0.2% of board directors are ever voted out. I suspect we're going to start seeing a shift in that, but it hasn't manifested yet. Now, regarding data, firms are begging for comparable data. This is what led to the rise of the disclosure regulations globally. But with the global regulations and the voluntary standards, firms are still finding that they don't have the information they need to make an informed or comparable decision. Now, related to the regulations focus on more than emissions, but everybody is focused on emissions because that is kind of the big hot topic right now. Most of the regulations, including the SEC's climate rule, also focus on climate risk. It is extremely rare that I have talked to a company that is looking at their climate risk. Now, here's where things get interesting. An ESG crisis is currently brewing in financial services, specifically with commercial real estate. And there's a couple of factors. It's the move to hybrid work post-COVID and low occupancy rates in cities. It's climate change along coastal cities. Even Chicago is slightly sinking into the lake, and a mountain of commercial real estate loans that are needing to be refinanced through 2025. All of these factors make for a great and potentially horrible ESG story. So if you're looking for kind of a trend that's currently developing to see how an ESG trend, to see how it might play out, commercial real estate is the one to focus on. And then lastly, while companies have engaged in green hushing, some firms across banking, capital markets, and insurance have left their net zero alliances because it's causing too much confusion on where these institutions draw the line between impact and ESG. So before we get to the last trend, let's talk a little bit more about capital markets, because this is what we're going to talk about in the use case. And this view is what opened the door to the anti-ESG movement. Much of the growth and challenges that ESG has experienced since 2020 have come from the capital markets view. Now, I'm not going to sugarcoat it. In the rush to capture shifting investor sentiment, there was a rise in conversation about doing well by doing good and win-win, which does not exist. Like, there might be cases, but it's really, really rare. So capital markets firms were trying to capture these opportunities and charging more and higher fees in order to do so. ESG kind of seemed like an easy way to wrap investors' heads around anything related to E, S, or G topics. But in reality, nobody could tell what these funds were doing. If you go out and read the fund prospectuses, it is very hard, if it's sustainable or ESG labeled, what it's actually trying to get at. Now, we have regulations that attempt to address this, like the EU has SFDR, the SEC has also considered specific fund labels around ESG as well. So remember, in integrating ESG or related topics, it is critical to communicate what the financial product is doing at a deep level. But there's also a lot that ESG and impact have in common, and they do flow in and out of each other over time, but they're not necessarily the same thing. So let me give you an example using a social example. So last year, the Swiss company Swatch had Pride watches that they were selling globally, clearly trying to capture an opportunity with a specific demographic. So very much aligned to the S in ESG. In May of last year, the Malaysian government, which has laws against same-sex partners, confiscated all of their watches ultimately leading to an ESG risk. So in other words, ESG and impact can intersect, but it's pretty complicated. Now, the confusion about whether institutional investors and firms were out to save the world or if they were a fiduciary, so ESG and impact, has led to a convenient boogeyman for some conservative states. In the summer of 2022, 19 states' attorneys generals sent an angry letter about energy divestment and ESG to the CEO of BlackRock, even though that wasn't what BlackRock was trying to do. Texas even went so far as to create a blacklist of firms it refused to do business with over ESG. Now, this also led to congressional hearings on the topic, where both parties talked past each other and couldn't even come to a common definition. This is why I always start with a common definition in my presentations. Now, as a result, investors have pulled out $13 billion out of sustainable funds in 2023, the biggest outflow ever recorded from sustainable funds. Now, what's funny though is that Morningstar, and if you're from Morningstar, I would love to have a conversation with you about this, because I've reached out to some people. Morningstar cannot differentiate between sustainable and ESG investing. So it's really hard to tell what's happening here. Now, in the meantime, there's a danger with anti-ESG for firms. The Carlyle Group was really the first one to call this out. They listed anti-ESG as a material risk in their 10K filing, and they weren't the only ones. KKR, BlackRock, and State Street did as well. The real challenge, though, and the disappointment to me, is that the anti-ESG push not only pulls back impact and progress, but it also halts companies from examining the effects of ESG issues on the company, which puts every company at risk and doesn't allow them to pursue new opportunities. But hey, this slide's green, so it's hopeful. So you can address it. So like anything ESG, inaction isn't a strategy. You need to face anti-ESG head on. Per a Workiva survey, 82% of institutional investors haven't changed how they've made their investment decisions, regardless of the anti-ESG push. So there is hope out there. Plus, for those of you who are more impact-minded, which I would imagine is a majority of you, according to a new Morgan Stanley report, I think it was just published last month, 77% of individual investors are planning to increase their sustainability investments in 2024. So don't despair with that $13 billion number. Hopefully, a renewed interest from these individual retail investors can influence the institutional ones. Now, there's some bullets under the graphic here. These were from a Thomson Reuters article that made recommendations around how to address the ESG. And I kind of added, there were three, I kind of added my own in here, but used it for inspiration. You can see the title there in the lower right. First off, mainstream ESG and your investment strategies across your firm so that executives, analysts, and marketing are all aligned on what products do what things and how you go to market. Second, and I write this in my book, ESG is imprecise, but your message needs to be balanced and clear when communicating externally. Be consistent to your mission around your ESG investing strategy, and be consistent, especially when responding to the states. Understand the regulatory landscape and what litigation and laws are currently in play. And of course, understand your state contracts and what's being expected as well. Now, there are many takes on how ESG intersects with investing, and this is just one that I came up with. I'm going to try to go a little bit quicker because I can see that I'm getting close on time. So first off, we have kind of the anti-ESG or traditional investing in the top left. This is where ESG isn't really a consideration. On the opposite end, we also have ESG integration, where ESG factors are well considered. Material issues are understood. Engagement happens. These two in the top are more value-based. And then along the bottom, we have two that are a little bit more values-based, which is thematic investments, like you can invest in a fund that maybe engages in plastics packaging reduction or water replenishment projects. Or you can invest in specific funds that are trying to invest in companies that are actually making an impact out on the world, which sometimes have concessions. Now, we're almost ready to break into groups, so I only have 2 more slides. And feel free to take a screenshot of this now, because this is just very high level of how I kind of viewed what the asset managers you'll be discussing published and what I've heard them say in different places. There are going to be some links to pre-reads to look at. Just a note, Vanguard does not have an annual report, so there isn't an annual report for Vanguard, but we do have a stand-in for that. I'd like you to pay attention to the universal themes on what these firms are saying in their reports versus what you may have heard in the media or news about them, or if you work at one of them. From here, foster and facilitate a discussion based on kind of the understanding that I've hopefully given you about ESG today. And then for the last 5 or so minutes of your group, we're going to be talking about a specific proxy vote that recently came up at Jack in the Box. Again, we're in proxy season. So the Accountability Board launched a proposal for Jack in the Box, which did pass because Jack in the Box had not disclosed its emissions. Now, Jack in the Box does not believe that their GHG emissions are material, which is what that little A stands for in their materiality matrix. Well, I also have the materials for the Jack in the Box proposal, so you can read their response as well as their sustainability report, which contains this materiality matrix. And I'm curious to see, based on your understanding of the asset manager that you're covering, you don't have to cover all 4, what do you think that asset manager voted for this proposal on behalf of its shareholders? Okay, so with that, I think we're going to hand it back over and we'll start breaking us out into rooms, and then we'll come back and have a discussion.
Oh, there they are. Here's everybody. Hey there, everyone. Just give it a couple more seconds to make sure we have everybody covered. Okay, thank you so much for taking the time to do this, to have the conversations. We'd love to hear what you were thinking, what you came out believing, if there were themes during the conversations, any questions you might have based on what Matt presented. I would ask that you raise your hand and we'll try to do everybody in order, or if you're shy, you can put it in the chat and we'll try to address everybody we can. Please feel free. And don't forget to put yourself off mute if you raise your hand.
And just remember, there are no wrong or right answers in this space. Wow, anybody have an interesting observation on the 4 asset managers, or did anything you read change your opinion on the 4 asset managers?
I see a hand going up of Sean, and after that, maybe I can speak. Sean, you go ahead and then I'll speak.
Sure, happy to. All right, so I had State Street, and we talked through some of the docs just based off of what we read. So we might be missing some information, but in general, thinking through those questions, it definitely seems like there's this baseline of managing risk, which is what they do, and managing opportunities. So by integrating resiliency to their kind of supply chains or partners or portfolio companies, by making sure that they are compliant to any regulations. That's like the ground level that they're really focused on. And that kind of is more material to their company. We did not see a save the world mentality. So I was describing it as more reactive ESG programs rather than, I think, proactive. So less so in terms of how can we use our core competencies in the world to actively promote emission. So a lot of it was language around reaching preset goals, but not necessarily inherent kind of vision or purpose within the company that they're striving towards, despite that. So just an observation that we had and we talked through on State Street.
Yeah, that's a really good, I couldn't see who the second person was that wanted to speak. That's a really good observation. One of the things that I'd say about the last point that you made, companies, a lot of firms are trying to do everything, so they don't take a one-size-fits-all approach across the organization. Like this fund will do this fund will do that, or this product does that. So it's really difficult. That's one of the problems with why this is so difficult to suss out.
Definitely hard to parse it. No, thank you.
Yeah.
Who
I
was
think
the
Nidhi
next
was
person that
next.
spoke?
I think it was Needy. Yeah,
Nidhi.
hi, this is me. I want to keep my video off because my internet is running on a poor connection. So thank you, everyone. And Matthew, this was really good. But I and Angela and another person in our group, we were discussing State Street, but we we went a bit astray, Angela, talking about other stuff. But yeah, my immediate observation, Matthew, was obviously State Street being State Street. Yeah, beautiful documentation they provided, long wordless responses on what they're trying to achieve. But to me, who's been in this space for some time, it's all greenwashing. Okay, I'll say it out loud. There are no numbers that match their aspirations. There's no matrix along with it. Maybe I didn't go through all the 98 pages of the order information piece they provided. So for the audience, what you're looking at really is that there's a baseline, and then there's a measurable matrix to continue to show that from that baseline, which is really the upper mouth of their jaw, bringing down the carbon emissions, right? So we are working at a mountain top, and we are looking towards a cliff. That's what the view should be, and that view should come out from the report. Right now, State Street's documentation that I read so far looks like a wordless journey of yes, we need to do this. It looks like a political, information pack as to this all we need to achieve. Nothing more beyond that. But that's the truth. So I come from the financial services and banking sector, and you won't believe I worked for 2.5 years with an organization. All they wanted was in their credit lending suite was one box to tick in the front line to say, yes, we have done ESG. That's all. And ESG is such a big, it's like a framework to constantly train your staff to pinpoint on any emerging risk that becomes materialistic. That's what ESG is about. You want to train your staff, you want to learn everything about ESG, learn about two things, materiality and externality. And none of the reports of any of these organizations that we're talking about today has ever listed that. But we'll get there. Unfortunately, US is not leading in that area. Europe perhaps is. But we'll get there. But I think it's a great exercise, Matthew, to be frank, to go through what specific nuances exist in these information out in US market, because the same companies will have a very different kind of information posted in European market. Thank you.
Right. Yeah, that was great. Let me just say one thing. You said a lot of things, and I largely agree with everything you said. Think about if you're a board of directors and you're reading this, like BlackRock is your biggest institutional investor, or Vanguard is, you're reading these documents, you're hearing this ESG pressure out there. Think about what a board of directors might think. Like, they are just as confused. They're like, what am I looking at in these documents?
Yeah, exactly.
Yeah,
That's what
and they don't know
greenwashing is
how
all
to actually.
about.
Yes.
You give so much information in a narrative that nobody gets to understand what exactly are we trying to achieve through this.
Yeah, exactly right. Great point. Judy, well, actually, I don't know who was next. Was it Judy?
I think so.
I think so.
Hi. Wonderful presentation. And like many people on the call, I've lived both in Europe and US. I was in financial institutional marketing for 15 years. But basically, as an economist and an MBA, some of the things I find confusing myself of E does not equal S does not equal G. And I really loved your presentation, Matt, describing the genesis of ESG. And I often wondered, really, like, why did we need that when there were SDG goals, which to me are much cleaner, and the buckets are much cleaner, and the EU parliaments and the mandatory reporting is much further ahead of the US. So I'm like, why did the US have to do ESG? And I mean, I get it, but I feel like it's just become kind of a mess. And going from voluntary to mandatory reporting, As we all know, I think SEC, the watered down version, which is still being sued. I mean, now we're like, okay, we can't even rely on the mandatory reporting, right, for a while, except for US companies that must comply with the EU, right? So our conversation was kind of around the differences in US versus European-based companies, and also the difference in investing in US versus European-based financial institutions. But mostly just wanted to point out that for me, a lot of the perception, the consumer confusion in ESG is actually the combination of ESG. And they're all beautiful concepts and very needed in running corporations. But to have a whole mutual fund kind of and other investing vehicles around them as a combo pack, I think it's a little hard to make it work. So back at you, Matt.
Yeah, it is. It is tough. Like if you say that you have an ESG integrated fund, it is tough to say, like, what does that mean? Like, are you looking at climate? Are you looking at emissions? Are you looking at social justice? Because those things mean something different to every company. And it's not easy. The one thing, and I write about this in my book, I can't remember what chapter I hit it in, but there is an intersection between all three for every company. Those are hard to find sometimes, and sometimes they're not. Like a topic may not hit all three. Sometimes it hits 2 out of the 3, and it's, all over the place. But for me, so funds have their own problems. You're totally right. For a company, I always am like, you really, like, that's why in the book I talk about stakeholders and materiality matrices. Like understanding those 2 things are core to your operations, because then you can start looking at them. And actually, one of the things I do write about, I think it's in chapter 8, is trying to connect the dots between material issues, because there's connections between them. Like I love materiality matrices, and I'm a nerd for that reason, but like finding the interconnected relationship between those issues, like turns it on to a whole other level. So yeah, the funds are tough, but for companies, I really like ESG still, but I agree with you on funds. It is tough. Yeah.
Thank you.
Yeah. Okay. So Romina, you corrected me. I didn't know. I apologize. But yes, please go ahead.
Totally fine. I only wanted to clarify because I know it's very confusing. I'm not even sure if that's right. Hello, everyone. Good afternoon. My name is Romina. I was in a chat breakout room concerning the BlackRock funds and the BlackRock kind of approach. I'm an environmental scientist and a software engineer. I'm coming from a technical engineering background, also research. And with my group, we talked about the fact that, honestly, much like State Street, it seems the BlackRock approach is kind of wait and see, which is very frustrating because we're literally in 2024. And there was nothing substantive in their documentation, their stated statements about their methods or what they want to do. They're going to watch to see the new international sustainability standard that was listed in 2023. And they noticed that the UK, Australia, different countries in Asia, and maybe Taiwan are going to follow this standard. So now they're keeping a track on it because other countries have said that they're also going to buy in. It was also a very reactionary wait and see kind of methodology. There was nothing more clear or defined in how they're going to invest their money to help support hit ESG. There was nothing substantive there. It's very frustrating to see that. And again, for me personally, coming from a background where I have done a lot of environmental research and I've done the software engineering in the background to help support small companies who are trying to make a change, everyone is waiting for someone big to become a new titan in sustainability, but there is no real titan yet. Even Tesla, for all of its quirks or underground tunnel, they haven't really done much for sustainability yet, because to be honest, everyone that we see who's at that level, all these corporations, they're most concerned about profit. Yeah. And if you're most concerned about profit, how is anyone going to lead the turn? So I would love to hear from you, either in the 72-hour AMA or in parts of our discussion today. How can we help every single person in this room become incentivized to be in those conversations at the higher level at these corporations to help inform policy and investors? Because that is completely what's missing. We don't have any environmental scientists. They're not paid. We're not incentivized to take those issues as a job. And
Yes.
I've spent my career now trying to figure out how to break into that so I can meld policy and science into a real substantive, corporate level approach.
Yeah.
So thank you so much.
Absolutely. So you bring up an excellent point. This is actually the exact reason why I wrote the book. The premise of the book is that companies can save actually, in the introduction to the book, I said this book will not save the world. So full disclosure, the book is not going to save the world. However, by understanding a company's material intersection with this topic, the beautiful thing is the company can save the world in only the way that it can save the world. So in other words, if I'm a beverage company and I see all of this emissions floating around me, that's all fine. Like all the emissions disclosure is great. But if I don't take care of my local watersheds, I literally can't make my product anymore. So like understanding that is how the company makes that impact. Convincing the company to do that is a completely different thing. But what I'm finding is these issues are starting to creep. Like they're starting to creep up on companies. And inaction is like companies are learning that inaction is not a strategy. You have to focus on these issues. So I'm going to paste something quick in the chat because it's not environmental related, but it's a headline from the New York Times that was making its round on social media. Boeing cannot make money if they're not focused on the social issue of safety of its stakeholders. Like, this is how ESG works. So anyway, I will stop there.
think-
But I'm more than happy to pick up that conversation in Slack. Shikarla, I see you have a question.
I
Hi,
think,
Matt.
unfortunately, I think we have to wrap up because we had
Okay.
until 1:15. I apologize. Anybody who still has questions, please go to Work on Climate Slack channel and choose Learn Finance. Join Learn Finance. We want to have the more the merrier. You can ask any questions for the next 72 hours to Matt and just tag him. He's Matthew Sekol on Work on Climate. So please do that, Matt. Thank you, first of all, so much for this presentation. And thank you for being willing to continue to answer questions. Obviously, a lot of people are really excited about this topic. Finally, I think we're going to put a slide up. Matt has referred to his book, ESG Mindset. He has been kind enough to offer us a QR code with a discount if you want to pre-order it. Sounds like something that would be very valuable and very cutting edge in terms of where everything is for corporations with ESG. Well, if everybody would, well, actually, one more thing. We also have a survey that we'd like you to take. And it's seriously like a 2-minute survey, but it's very helpful for us to know what your feedback is, what you liked, what you didn't like, so that we can give you more content that you really want. So if you could also click on that QR code, I'd very much appreciate it. Finally, I think if you get that QR code and we'll take a really quick group photo, this will be posted on all of our channels. So if you're looking to see this again, YouTube, Slack, LinkedIn, all of those, it'll be on there probably in another day or two. So, feel free to share it, watch it again, whatever you need. Thank you to everybody. Thank you to the events team. They did all the heavy lifting on this. They're all volunteers. It's pretty amazing. So I thank you all for being here and being so engaged. It's always a great meeting when people are so excited. Thank you.